Anthony here. Welcome back to Metals and Momentum. So if you're new here, I write an investment newsletter. You can find me on Substack. That is Metals and Momentum. You can see the page right here. What I'm going to do here today is go over this article that I wrote. It's called "The World Wants to Diversify Away from the US." This is an article essentially talking about the investment case for Brazil. And I think this is super interesting. There's a huge wedge pattern happening, and I love when investments first intrigue me because of the technicals, and then you start to dive into the fundamentals of that investment and everything kind of aligns. I've seen other traders talk about how, Brazil is super interesting, but they've been talking about it for a long time. And I've been watching the technicals on the chart, and I think now is a very interesting point in time. And I just want to go over the bull, the bear case for Brazil, and just talk about why this is going to be an interesting opportunity. I even have the Yahoo Finance kind of up here, the page up here, and we can take a look at valuations as well. The S&P 500 is super expensive. We're talking about a 27 PE ratio on the S&P 500, but the Brazilian equities can be had for much lower valuations. We're talking 11 PE and much higher dividends as well. And that's one thing that I was thinking about is, where are people going to get yield? And we can see on the Brazilian equities, this is paying a 6% dividend opposed to the S&P 500 paying 1.13%. So I want to go over this article here and just talk about some of the investment implications that could affect this whole position. I want to point you to the link in the description where you can kind of go over this yourself. I'm not going to go over absolutely everything in this article, but I'm going to try and summarize this because this is a fairly lengthy article, but I want to point out a few highlights and then just go over the whole investment kind of thesis. So one thing that I've pasted into the article here is this link, and it's actually former Prime Minister Stephen Harper talking about how he was advising Mark Carney to kind of navigate these tariffs that the U.S. is putting on, and what he might do in his situation, and what he was actually saying to Mark Carney. And essentially, in this short little clip, he was saying that he was advising the current Prime Minister Carney, to look for other sources outside of the US and China. We are Canada. We are very reliant on the US, and sometimes that is to our detriment. And that's what he says in this short little clip here. So I started to look into, are flows of money increasing over time into Brazil, or are they decreasing? Like, where are those places that Canada is starting to put money into? So I actually noticed that over time, we are actually putting more money into Brazil. And what are we actually getting for that? So there's a list in the article here of things that we're actually exporting that we're actually importing from Brazil. And it's all things like precious metals, very raw commodities type of things, organic chemicals, precious metal compounds. That makes sense because, we do a lot of mining here in Canada, sugar, aircraft and spacecraft. I'm curious as to what that actually means. Maybe like the materials to build those things. That's a decent portion of the money that we're putting into Brazil. And then things like machinery for nuclear reactors and boilers. So you could actually see the dollar value. The highest category, $1.93 billion US dollars, was put into Brazil for precious stones, metals, and coins. That makes sense. Even though, Canada is like a powerhouse for mining, we're still importing a bunch of precious metals and coins from Brazil. So these numbers were actually pulled from 2024. But if you go back and look at previous years, these numbers are actually increasing. So that was kind of an interesting kind of thing. And it just goes to show you that there are other countries that we are looking to pull from and be less reliant on the US. And that is just becoming more and more relevant over time. And I think now more than ever, Canada is looking to diversify where it's getting its key products for. I was thinking about like during COVID, where, you know, we were having all sorts of problems with China. We couldn't get PPE. Even though, you know, our medical facilities here in Canada are fairly significant, we were lacking the PPE because all that was coming from China. So I was curious as to like, who is the largest trading partner for Brazil? It's definitely not Canada, but although that is growing. So I was curious, like, so how much has Canada actually purchased from Brazil? And I found that figure. Canada has purchased $7.45 billion US dollars back in 2024, or I guess they didn't purchase it. They put that money to work in Brazil. But China has purchased 64.7 billion US dollars of goods from Brazil. That is 8.7 times more than us Canadians. So that is Brazil's largest trading partner. So if anything happens to China, it's probably going to affect Brazil. And that is something that we have to consider when thinking about this investment thesis. So I've posted a chart here, and this is super interesting. And this is what got me like a little bit more excited in the near term. This is the Brazilian chart, and we're looking at 1 month candles. So we've essentially formed this massive wedge pattern, and also we are chilling on this like little base, this like floor, I guess, that this point of support that I've highlighted right here. So if we go back to 2008, we can see this massive run up. We saw the run up in commodities, and also the price of gold started to run before 2008 crash as well. Then we see that 2008 crash on the Brazilian chart, and keep in mind we were back up at $101 at the peak of the year, and today we're sitting at 27.53 ish. I think it's popped just a little bit over the last couple trading days, but we're pretty close to like $29 or so there. We see the massive run up, we see a massive crash, and that's where we first start to form this point of resistance, or like a floor on the chart. And it's amazing that you can go back to 2008 and you start to see that floor actually being hit. And then we see a small little dip. This is about like 2016, 2018 or something like that. And then again, we're back in the wedge pattern. We see it tap the like floor that we've created here multiple times since 2020, and even small little dips beneath the floor, but then we pop right back up into the wedge pattern. And now we are very much in that wedge pattern, and we're actually getting close to a breakout, either to the downside or the upside. And usually wedge patterns are very aggressive moves. So the question that I was thinking is it more likely to bounce to the downside or the upside? And that's where the overall valuations started to come into play. So if I hop over to Yahoo Finance, I was looking at the PE ratios of these stocks, and these are very inexpensive, and also paying significant dividends as well. So I was looking at the S&P 500, and I was comparing the PE ratios of the S&P 500 versus the Brazilian equities. Now, naturally, of course, you are going to price the US market at a higher multiple than a Brazilian market, just because of the like political risks, I guess, that there is in Brazil. So that's totally understandable, but are they discounted like too much? Like, would a 15 PE be unreasonable for the Brazilian equities? I don't think so. The current PE for the Brazilian equities is 11, and the S&P 500 was 27. And then also think about that dividend yield. If you're somebody who is looking for a higher dividend yield than, say, even like a US bond, of course you're going to take on more risk. But if the valuations are low, then it kind of limits that downside. So I was looking at their dividend yield, and that is 6.03% on this basket of equities, which is very, very high. So these are very low valuations, very high dividends, and the chart pattern is starting to look like it might actually play out and it's going to decide whether it bounces upward or lower. And how low does a basket of Brazilian stocks get? Like, would a 9 PE be ridiculous? I think it probably would. So if this wedge pattern plays out, then I think we're probably more likely to bounce to the upside because they're not expensive stocks. So that's the thing that I was first got me interested in. And I'm like, okay, the chart is so interesting. Let's build out the bull and bear case. So I want to go over a few of the bull points first, but really it's the bear case that was super interesting. And the things that I tried to include in the bear case were points that would definitely be bearish if the right set of circumstances played out. But when I was building out this bear case, I was like, man, like these bear points are kind of the reason why I would want to be in like a Brazilian equity or a basket of Brazilian stocks. It's kind of funny. So let's go over the bull case first. One of the first points is if you're into this commodity super cycle, then Brazil would actually be like the place to be if you wanted to benefit from a commodity super cycle, because Brazil is a major exporter of iron ore, oil, soybeans, beef, and other agricultural commodities. And these are the types of investments that I really like to do. Like essentially, if it's like essential for your survival, then I try to invest in companies like that because they essentially have pricing power, right? Like, yeah, we can go into a recession, but you're still probably going to buy beef, or you're still probably going to buy oil. You're still going to drive your car to work, right? So these are the companies that I kind of like to invest in. And it's interesting that the major exporter of all these commodities that I just listed out is Brazil. So if you're thinking that, inflation's coming back, I personally feel like we might go through a deflation and then a larger wave of inflation, because the deflation is probably going to be met with serious money printing, probably like $10 trillion in the next round of money printing, and then of course lower interest rates. But I also think that, maybe interest rates might go a little bit higher in the long bond kind of area. So this is something that I'm kind of monitoring. I've been saying to my Substack subscribers that we want to be cashed up. So I don't think this is like happening right now, but over the longer term, I think commodities will go higher. And also, if you're thinking that China, India, like these countries are going to grow, then they're going to be looking for sources like Brazil to source goods as well. And just think about like how the Brazilian economy actually works, and like the overall like weather. Like there's so much more time to grow things over in Brazil than compared to Canada. Canada, it's starting to get freezing cold here, and we're like in August. So kind of crazy. And I think that Canada is going to be looking to source goods from other places other than the US. But then I'm also thinking that there are going to be other countries that are going to eventually get richer. And when countries get richer, the first thing that they're going to consume is going to be commodities. And they're going to increase the amount of food that they're actually eating. And this whole like technological movement is something that I'm definitely thinking about, because if these poor countries start to get richer, the first thing that they're going to do is start to increase the calories. So who's providing the beef? Who's providing the soybeans? these are the countries that I'm thinking about, and that is Brazil. So the other thing that we just briefly touched on is the attractive valuations that the Brazilian equities actually offer. So I won't touch too much on that. We talked about the strong dividend yield. So this EWZ index actually has sometimes given you a dividend yield of about 10%, depending on where you kind of catch that right now. So right now we're currently sitting actually at 6% rather than the 5.6% that I've had listed here. The US stocks, like, they're generally under like 2% dividends, and I think there's going to be not everybody is going to move out of the S&P 500 and move to something like Brazil. That's ridiculous to kind of think about. There are going to be some investors, though, that are going to be looking for higher yields, and I think they're going to start to move money out of the US and bring that over to something like Brazil. So we have to pay attention to interest rates and inflation, especially in these like Latin American kind of countries. And one thing that I was looking at is Brazil's central bank has been really ahead of the curve when it comes to rising interest rates to combat inflation. In 2020, their interest rates were actually at 2%. And then, of course, they experienced that large wave of inflation like everybody else in the world. And they were very ahead of the game. They started to raise interest rates, and they actually, their interest rate is actually sitting at 16 or 18%, far higher than majority of the other countries, signaling that, they're not willing to let inflation remain hot. They're the type of country that has gone through these periods of time where they've experienced high inflation. They know what it's like. They know this thing. Whereas like Americans, like, they don't really know this thing. They're just experiencing it right now. So they know how to deal with inflation in Brazil. Lula is their current president, and he does appear to have a grasp on taming inflation. That's why they've jacked interest rates so high, and that's pretty normal for these like Latin American countries. And what I was thinking about is, now that inflation is under control, Brazil actually has room to cut rates ahead of other countries. So they could actually stimulate a little bit of growth by lowering rates. They could also boost consumer demand by lowering rates. They can spur a little equity inflows by lowering rates as well. So this is a country that's kind of ahead of the game on inflation. And I was thinking about how, like, a lot of countries that are like superpowers, they've only known like what's on the up and up, whereas these like smaller countries, they're a little bit more scrappy. They're almost reminded me of like a boxer, when a boxer is really young, like Mike Tyson, when he's just coming up, super scrappy, super, aggressive, and he's willing to do anything. But as a boxer gets older, as a boxer gets richer, then they become, they don't work as hard. They're not like, well, like, I need money to pay the rent and like to pay my bills. They don't work as hard, and then they start to fall off. And I think that's where we're kind of at. So I'm looking for other opportunities where that boxer isn't quite so old, and they're not getting lazy. I'm looking at countries to invest in that are scrappy and, small, and they're really hungry. That's the kind of investments that I'm looking for. So I was looking at the mortgage market, and I was curious, like, do people really like, there's a lot of Latin American countries that, getting a mortgage for 30 years is not that common. So I was looking into the mortgage market, and it's relatively low compared to developed countries. Brazil's mortgage to GDP ratio is around 10% versus 65 to 80% in the US and in Canada. However, it has been growing over the past couple decades, and I bet this is probably due to a lot of foreigners that are actually probably coming into the country and looking to invest using debt. not necessarily these locals taking out debt to buy real estate themselves. So that's an interesting thought. It's something to kind of monitor, but to know that mortgage to like debt to the housing kind of ratio is fairly low, and it's not super common to get like a 30-year fixed rate mortgage in Brazil. So that's something that is nice to see. The fifth bull point is actually political stability and fiscal reform. So this is kind of that boxer analogy that we're talking about here. Over the long term, you could see that Brazil has gone through boom and bust, but they've gone through these hard times, and they're starting to make political decisions that lead them away from that, because they're just sick and tired of these like massive boom bust cycles and political corruption and things like that. So I think these countries in like Latin America and these smaller countries are moving away from these like left-wing policies and just focusing on becoming a little bit more capitalistic. And that's something that I'm very interested in, and that generally will lead to growth within the country. I have this listed out in here in the article, and it says bad things don't happen forever and good times don't last forever. So it's that whole analogy where, you know, when the boxer comes in, they're super scrappy, and when they're making millions and millions of dollars, they become a little bit lazy and start to do things that, you know, aren't super fiscally responsible, like getting into things like ESG is a big thing here in Canada, and it's to our detriment because, you know, we're not maximizing the profitability because we are already rich and we are already fat. Whereas these countries that are not rich and are not fat, they're making policy changes to benefit the country and the investment that your people are making in their country. So the next bull case is favorable currency trends. The Brazilian real has stabilized and may strengthen if the interest rates fall while inflation stays low. So this is coming back to the interest rate cycle that they're actually in. Yes, they've experienced inflation in the past and they know how to deal with it now. And I think the economy isn't going to fall apart like maybe some of the other countries that are just experiencing inflation right now and like don't necessarily know how to deal with that properly, or even like how to deal with like stagflation, or even get to the point where stagflation is a problem. They would be in a position where they know how to mitigate that because they've experienced it in the recent history. So I think the Brazilian real currency, it can get stronger over a little bit of time, and the problem with this ETF is that if the US dollar increases in value and doesn't decrease in value, then you have some currency exchange risks. So there's a little bit of a risk there as well, but the Brazilian economy, they know what the sting of inflation is like. So this is something that we just have to monitor. The other thing that I was thinking about is the China recovery and like trade links. So this is the whole idea that countries are going to look to source materials from other countries outside of the US. Brazil is deeply linked to the Chinese demand. So that is something that we have to monitor, especially for iron ore and soybeans. So if the Chinese are actually stimulating the economy, which they currently are, then this would theoretically be a bull case for Brazil, right? They're gonna import more goods from Brazil into China, and this is going to lead to more dollars flooding into Brazil. So what I just learned about just recently, this article is a few days old now, and I wrote this a little while back, was that China is actually stimulating the markets to the equivalent of 1.5 trillion US dollars. And mostly what China is actually after is commodities energy, and gold. So all of these items on this shopping list can actually be supplied from Brazil and countries like Canada as well. But we're working on that. There is also a direct link to the global commodity prices and Chinese economic stimulus, which is kind of wild to think about, that one country can affect all commodities, and if they are stimulating, then they're buying commodities and bringing those into the country, and that is affecting the price of all of these commodities. The housing crisis in China, that does not look good, but the China government is implementing stimulus and likely will plug a hole in that problem, potentially temporarily. We'll have to see how that kind of plays out. But if other countries are coming to Brazil looking for cheaper goods, the one country that I was thinking about, like Africa can source things from its own country because it's very, very cheap in Africa, but they're not going to come shop with like Canada, because buying things from Canada is going to be very expensive. Our labor here in Canada is super expensive, whereas in Brazil, it's actually quite affordable. I think the average salary in Brazil was something like $600 a month or something like that. So labor and that's like for like a family, like a husband, wife, and a kid, right? Like $600 gets you by in Brazil. Whereas other countries like Canada, like we're talking like $2,000 for freaking rent. It's crazy. You're not going to come, like poor countries are not going to come shop with Canada, but they might actually go shop with Brazil. So let's go over the bear case. Some of these bearish points are actually quite interesting because, like I said, it's these points that I was thinking about that are like a bear case for Brazil. But actually, when you really think about it, it's like, actually, that's kind of why I want to invest in Brazil. So one of the first things that is kind of a bearish thing if we're going into a deflation environment is Brazil is definitely over-dependent on commodities. So the whole Brazilian equity ETF is highly concentrated in energy and materials. This could be a bearish point if we enter into deflation or we don't enter into that commodity super cycle. And again, I think this is going to come down to managing the position size within a portfolio, and a slowdown in China could definitely affect things like the exports of soybeans and things like that. Their real estate market, they're getting steel from Brazil. So this is something that could hurt Brazil and the overall equities if China goes into an overall decline. And that is a possibility. So again, limiting the position size is something that we definitely have to consider. But the over-reliance on just a few commodities makes Brazil kind of vulnerable to any kind of external shocks and like cyclical downturns. So even as this ETF starts to rise, I would start to look to trim those positions, knowing that, we're probably going to have waves in this cycle, right? The other thing that, of course, is going to be a huge problem in Brazil is political risk and government intervention. President Lula, that is the president of Brazil, he's been pretty stable so far. Not too many crazy stories have come out of Brazil in the last little while, but of course there's always that opportunity for swings, and this is just how Latin American countries kind of work. There is political risk there, and investors sometimes fear increased taxations on corporations, and then pressure on state-owned companies like the Petrobras, which makes up a large portion of the Brazilian ETF, which is like one of the the largest like oil company in like the world, but has a huge stake in Brazil. So this could be a problem. Populist spending programs, a wave back to like left-wing policies, could throw this investment thesis off for sure. And it's just something that we have to monitor. This is a place where, jurisdictional risk can be a problem, especially if you're interested in investing in mining companies. They're always talking about jurisdictional risk. There's there's a reason why that the ETF is a significantly lower PE ratio, because the risks are higher. But at what point does an investment become so cheap that it almost mitigates some of the political risks? That's the question that I've kind of asked myself. Of course, people are going to very much look to the U.S. to hold that core holding of U.S. stocks, but there is going to be some capital looking for less expensive companies paying higher dividends, and I think that's probably Brazil. So if we move to these more like capitalistic kind of policies in Brazil, then that's going to generally lead to higher asset prices, more attractive valuations in terms of like a better multiple, and I think that's something that we just have to monitor. So we've talked a little bit about the currency risk. A weakening Brazilian real, it could be a problem, and it historically does weaken during global risk-off kind of sentiment. And after all, the US dollar is definitely king. And if there is any kind of risk-off kind of moment in the markets, then we're going to see a flight back to safety, and that is going to be in the US dollar. And the Brazilian real could start to devalue itself, especially against the US dollar. So that is a problem, and it's definitely a risk here. But at the same time, this kind of goes for all countries around the world. Like even the US dollar has gone down significantly over the last little while. So investing in US stocks, the currency risk is always going to be a problem. The Brazilian inflation rate has been kind of managed by higher interest rates, so they were ahead of the game on that. But that's what I'm thinking about, is like maybe there's some room there. If inflation goes lower, then there's room to stimulate the economy by lowering those interest rates, because like I said, we're sitting at that 15 to 16% right now. So that's a positive sign. We'll see how that plays out. It's just something that we have to think about. We talked about interest rates. I'm going to skip over this bullet point because we've mentioned that a few times here. This one's kind of interesting. So this bear point is that the Brazilian equities have just been a poor performer over the last while. Essentially, we've gone down since 2008. But one thing that I thought was interesting is that the year-to-date total return is 33%. Now, the year-to-date total return on the S&P 500, I just checked yesterday, I think it's something like 11% or something like that. So there are definitely periods of times where valuations matter and people look for those better evaluated companies. And I think there's going to be moments where Brazilian equities actually outperform the overall US stock market. And we're seeing that actually play out right now. So the poor track record is almost like a contrarian indicator. And if we look at that wedge pattern that we had at the beginning of this episode, we can see that the wedge patterns generally play out either to the upside or to the downside, and which way that essentially is going to go is I mean, it's kind of a guess at this point. There's no definite answer, but I would rather invest in a place that has done historically not so well and on their way to forming that uptrend, right? I don't know if it's super smart to be invested in something that is just absolutely at an all-time high and at all-time high valuations either, like, for example, the S&P 500. This is something that I thought is actually kind of a bullish thing. Like, bad times don't carry on forever and good times don't carry on forever. Going back to that boxer analogy, boxer gets rich, they become fat, they become, wealthy, they don't take the same amount of risks, they start to implement kind of stupid policies to lower the overall prosperity of their country because they're already rich and they're already kind of fat. Think about Canada and the ESG kind of thing. The poor long-term track record of Brazil is actually kind of why I'm interested in that. And there's not many things that you can buy that are priced the same way than it was back in 2008. So if I go back to the 1 month chart here, like this is the opportunity that I'm seeing in Brazilian equities right here. So to get back to the all-time high, now I'm not saying it's going to happen in a straight line like this. Like this is probably going to take many, many years to play out. But to get back to the all-time high, that is a 242% gain from where we're at right now. Bad times don't last forever. Good times don't last forever. And I'm looking for that contrarian indicator, something that, hasn't performed over the last little while, but starts to form that little bit of an uptrend. And this is the potential gain on the Brazilian equities that I was looking at. And I'm like, wow, that's kind of interesting. On top of that, good valuations, high dividends, and the dividends can allow you to extend the time horizon out a little bit more because you can get paid to wait. So that's kind of the bearish point that I was thinking is actually kind of bullish. We talked about corporate governance concerns, corruption, political meddling. This is all a problem in Brazil. The other thing that I was thinking about, global risk-off environment. We talked about how the US dollar is kind of king. It's going, like, if there is a flight to safety, everybody's going to flush back to the US and probably go into government bonds and treasuries and things like that. There might be outflows of emerging market stocks in a global risk-off environment. And that's one of the reasons why I want to remain fairly cash heavy, but I'm starting to build this position ahead of that wedge pattern breaking out, because I think we're more likely to break out to the upside rather than the downside. And like I said, that huge dividend allows you to extend that time horizon out and get paid to wait as well. This one's kind of funny. The last point here is the concentration risks in the top holdings of Brazil. Now, EWZ is not well diversified whatsoever. The whole index is essentially the Petrobras, the Vale, and like big banks in Brazil. But that's kind of why I would want to diversify some of my portfolio into other countries that are very much linked to those core commodities, oil being one of them. The Petrobras is like the largest oil company in the world that has a strong stake in Brazil. So that makes up a large portion of this EWZ basket. So the S&P 500, a little bit more diversified, but the places that I think I want to be are actually in the exposure that I want is actually some of those top the top holdings that EWZ actually offers. So the last thing in this article is tariff risks. I'm not going to go over this. This video is already super long, but it is something that you should definitely read about and think about if you're considering investing in Brazil. There was this whole announcement of like 50% tariffs on Brazil, and I've included a few things that are actually exempt from the tariffs in this article. I'll leave that in the description if you want to go over that in further. This video is already quite long here. So I think that's where I'm going to wrap it up. If you're interested in getting this newsletter sent into your inbox, then hit the description down below. Go to my Substack. That's Metals and Momentum on Substack, and you can subscribe. I have a free tier that I send out. A lot of free information goes out to my subscribers, including this whole breakdown. This was a free post that I posted to my subscribers, and there is a paid tier as well. It's $9 a month. You get access to things like a stoplight stock indicator system, and it's essentially like a list of stocks, and I list them. Is this a buy, sell, hold, proceed with caution kind of thing? And it's like a stoplight, essentially, rating system that I go through on a bi-weekly basis. My newsletter goes out on a bi-weekly basis. If you're interested in getting that, hit the link in the description, and that is where I'm going to leave it. Thanks so much for listening. My name is Anthony. We'll see you in the next one.